Welcome back, everybody. I'm Tyson Nagasaka with Portfolio Planning. This is our 2025 recap video with one of our preferred partners, Kinsted Wealth. And this is a treat for us. We have the CIO of Kinsted Wealth, Brent Smith. Brent, welcome on. Thank you so much for doing this.
Thanks for the invite, Tyson. Always enjoy having the conversation with you.
Yeah, I love talking about this stuff. So we had quite the year last year. January last year, economists, portfolio managers, they were all kind of saying we're going to get through 2025, but they were predicting low to mid single digit returns, and that kind of wasn't the case. What were you seeing on your end, and what happened that things turned out so well?
I don't think the market really cares anymore about valuations or geopolitical risk or any of that. I mean, it's really surprising because there was an awful lot of risks in 2025, starting with tariffs and other geopolitical risks. But it seems that the markets just shrug that off really quickly. And you look at valuations in the U.S. stock market, they're they're near extremes, like 100-year levels. And so it feels that the market just doesn't care about valuations today or any of these other geopolitical risks. That said, I should point out that if you look outside of the US, valuations in Europe and Asia are much, much more attractive, and they still are more attractive than the US. So everyone continues to focus on the S&P 500. But the reality is the MSCI All Country World Index outperformed the S&P 500 by about 4%. But if you took the U.S. equities out of there, international equities did even much better than that. So I think we're
Okay.
starting to see a broadening. There's more geographical areas within the equity sphere that are starting to finally deliver returns that we haven't seen in so many years.
Very true. Yeah, it was hard to stay the course and talk about proper diversification. And
Oh,
there was only
yeah,
one pillar of performance for a few years there.
yeah.
And but it does still make sense. And I think you're the one that said this to me is diversification, true diversification in portfolio is the only free thing in investing.
Mhm.
And so you should do it. You should be doing that.
Yeah, no one cares about diversification when equity markets are up 20% a year, right? You
Yeah,
only care about diversification when you really need it.
true.
Yeah.
Very true. Um, So I have so many questions, and I'm not even sure where you want to start, but we had some really, really nice highlights from out of your guys' shop last year with the addition of, a sports fund that was really exciting to talk about. We had a nice little treat in mid-December from a holding
Mhm.
that was there. There was a whole bunch of like little nuggets that you're supposed to have from a well-built portfolio, and it gives
Mhm.
like a really good story and it gives performance. Is there one or two of those that really stand out to you that you want to talk about?
Yeah, I think the one and the biggest highlight was at the end of the year, which I think our clients probably saw a meaningful little bump near, I can't remember, near mid-December or sometime where, we've and this gets into private investing or private equity or venture capital and things of that nature, is that I've always said that you really have to have a much longer time horizon. Just because I tell you I think private equity is going to outperform, it's not going to outperform every single year. A lot of the returns from private assets like private equity or infrastructure or real estate, it tends to be back end loaded. And so the biggest highlight last year was near the end of the year where SpaceX revalued its business from a 400 billion valuation to an 800 billion dollar valuation. Now we had invested through a couple of funds in SpaceX back in 2021, so almost 5 years ago, and 2023. So we've been invested in SpaceX for a number of years, and we're starting to finally see, you know, the value finally starting to come to the forefront. I think when we first originally got into it, I think the value of SpaceX at the time was about $40 billion. It's now $800 billion with, if you follow the media, it sounds like, they're going to IPO sometime mid-year. And I think take it for a grain of salt, but what I've read is a $1.5 trillion valuation. So that had a relatively large impact near the end of the year on client portfolios. We still have a pretty significant clients invested with us, still have a pretty healthy exposure to SpaceX. I'll let you determine what kind of impact that'll have if it does IPO. The other one, it's a highlight. I think it's a game changer for us. It didn't necessarily add a lot of value this year, or this past year, is that we committed $100 million because that was a minimum commitment to a diversified hedge fund portfolio, a multi-strategy, multi-manager hedge fund. But we did it in a different kind of format. We're calling it a portable alpha strategy. Sometimes these things can be complex to explain, but essentially what it is, we had $100 million. We're getting $100 million exposure to the MSCI MSCI World Index, and we're also getting $100 million exposure to this portfolio, this diversified portfolio of hedge funds. Now, some people might go, "My God, you're leveraged 2 to 1. That is incredibly risky." It really isn't for a couple of reasons. The hedge fund portfolio is run at a very, very low risk. Put this into perspective, they run it at a annualized volatility of 2.5% to 4%. Equities are at about a 16% to 18% annual volatility. So incredibly low volatility. But the key feature of this is that historically, this kind of strategy does well when equity markets are selling off. So it's a strategy that we're actually targeting the MSCI World plus 4% to 6% a year in a structure that I think that if equity sell off will actually add value because it'll do better than equities. So you're not doubling up on the risk. That's about 50% of our global equity pool. So we only launched it October 1st. It's been in place since October 1st, and the performance we saw as of January 9th, it's already added about 2.5% over the MSCI World Index. Way more than we expected. I mean, we're only expecting, like I said, 4% to 6%, probably 5% over an annual period, but it's already done 2.5% or 2.75 in 14 weeks. So we're thrilled. I think it's going to add tremendous value to client portfolios over the foreseeable future. And I would point out that this is truly an institutional mandate. You are not going to find this strategy, I don't think, with any other wealth counseling firm in Canada. It's Morgan Stanley that manages this for us. Morgan Stanley's biggest client for this strategy is an Asian sovereign wealth fund with about $1.5 billion invested. So truly institutional.
Okay. That's great to hear. I was excited for this as well. I think having something that can give good, solid performance, even enhance performance and lower risk is always something that you want to hear about versus just taking more risk. I was having a conversation this week with somebody, and it almost seems like from a client's point of view, risk has been taken out of the conversation because of all of the social media and the finfluencers and everyone telling you to be 100% equities 100% of the time. It sounds good in the last 3, 4 years when things have gone well, but it's like people don't remember that things can always not be that great. We can have pullbacks in the market in certain sectors.
Well, let me tell you from experience back in 2008 in managing a $8 billion series of mutual funds in Canada, talking to clients in January of '09 after their balanced account is down 24%. Like theoretically, not theoretically, think about how long it took the equity markets to recover from actually how long it took the equity markets to recover from the tech bubble into 2008, and then the financial crisis, and then that took us, in theory, if you go back to March of 2000, it took the S&P 500 13 years to get back to that value it was on March or January 1st, 2000. People forget that. People forget when things are going well, no one thinks about risk. No one thinks about the potential tail risks in equity investments, and that's what we have to think about when we're managing client portfolios. It's not just all about maximizing growth. There's times where you try to maximize growth, and there's times where you have to preserve what you have. And given where valuations are, and I'm not saying that the S&P 500 is going to sell off or equities are going to sell off, but you always have to be aware of the potential risks in the marketplace.
Very true. Um, I think you've kind of covered this, but I do like to ask this question, especially when I have a portfolio manager with your background and the way that you like to design the portfolios. It seems like all of the oxygen, all of the conversations is pushing clients and investors to index. And we're even starting to see things where there's a little bit of like negativity or hesitancy when other advisors are talking about private equity being used in portfolios. And you've kind of covered why and how like properly built private equity can, be different than an index in a portfolio. But like, what are you telling clients when you're bringing somebody new over that maybe they've only had mutual fund exposure, they've only had index exposure, and you want to prepare them for how the cadence of returns might be and what the long-term view of dealing with a portfolio manager like Kinsted could be like?
Mhm. Yeah.
What are you telling them?
Well, there's a lot of unpack there, Tyson.
Sorry.
Yeah, no. Listen, our approach to wealth management is completely different than almost every other wealth counseling firm. We probably have more exposure to private assets than any other firm out there. And I always caution people when talking about privates, it's not the privates that your dad used to own, that he put money into a small oil and gas business and it blew up. These are institutional, uh, predominantly institutional private asset funds we invest in. And when I say institutional, these are firms that their only focus is private assets. If you think of an Ares, and a lot of people may never have heard of an Ares, they are one of the largest private credit managers in the world. They've got close to 600 billion US dollars of assets. That's what they manage. You talk about a Brookfield. A lot of people are familiar with Brookfield. They're the second largest private asset manager in the world. So when you're investing with us, you're getting exposure to the very similar, the exact same investments that other pension plans are investing in. We invested in a Morgan Stanley private equity fund 5 years ago. The Investment Management Corp of Ontario invested $250 million in the same fund that we're in. These are not retail investments. These are institutional investments where the minimum commitment tends to be about $10 million. And so you are getting access to strategies that otherwise are just not available to the average investor in Canada. That's what we're providing. With private assets, as I kind of mentioned, the return stream is not going to be the same as for public equities. If public equities are up 20%, we're probably not going to be up 20%, right? But the volatility of private assets is much, much lower than it is for public markets. So I think for clients, I always say, listen, if you're going to be a client of Kinsted, don't gauge us on how we did last year. You've got to take a much longer approach. And the reason why you have to take a much longer approach is because the assets that we invested in 4 years ago may not come to fruition. We may not see a lot of that value being extracted until maybe year 3 or year 4 or year 5. Case in point is SpaceX. We held it for 5 years, and now we're seeing, the fruit, with the expression, the fruits of that investment we're starting to see that come around. But I think the average, as a client, you're going to experience significantly lower volatility than a typical public market, investment, like a 40% bond, 60% equity, all passive investments. That's not, there's embedded volatility in there. It's very, very difficult. I came from the retail space, so I know that the diversification opportunities are extremely limited when your only investment universe is the public markets, right?
And I don't think people realize how small and how much that universe is shrinking. It seems to
Oh yeah,
each
yeah.
year there's less and less publicly traded companies, and less
It's
good ones
shrinking.
as
Yeah.
well.
Yeah. Like if you want, for example, if you want exposure, what's the hottest thing out there? Alternative artificial intelligence, right?
Yeah.
Data centers. Find me a public security that has 100% exposure to AI. I can buy NVIDIA. How about data centers? It's all private, predominantly private. So we've got a good relationship. I actually had breakfast with them this morning. It's a firm called Digital Bridge. They're one of the largest builders, developers of data centers in the world, right? You're not
Okay.
going to get that in a publicly traded vehicle. I bet you the majority of investors don't realize it. What's the stat? Something like 85% of companies that have revenue in the US of over 100 million a year, which is pretty significant, are private companies. So the vast majority of investment opportunities are on the private side, right? Forget
Hmm.
about just private equity. Talk about private credit or private infrastructure, venture capital. You want to get exposure to Anthropic, OpenAI? How are you going to get that in a public vehicle? You're not,
Yeah.
right? You need exposure to private assets if you want exposure to some of these emerging firms. So you're going to see a completely different, we just have a completely different approach to wealth management. You're not going to get 60% exposure to equity in a balanced account. You might get 30, right? But here's the thing is, when you look at private equity, and if you look at public equity, they're both equities. One of them
Yeah.
just happens to trade publicly, has a market, and the other is private. They're still equity. It's equity risk. So if you as a client think, my advisor said I should have 60% equity, well, you should have private equity in there. It's still equity risk, right? But
Yeah.
I think there's a lot of advisors, I've encountered them on LinkedIn, where if you don't have 100% in passive indices, your advisor doesn't know what he's doing. All right. So it's great when, I just put a shingle I just started as an advisor 6 years ago, and I've actually never experienced any downside, meaningful downside. I'm the smartest
Right.
investor out there.
Right.
You got to go through a couple of environments where it really tests you, where it's not a 3 month recovery, it's a 5 year recovery. We haven't experienced one of those in quite some time. And
Yeah.
so I think I'm not saying it's going to happen. Maybe it never happens, but
Yeah.
history is against that never happening again. So who
Yeah.
knows, right? So
It's funny that you say that because I got my mutual fund license at the tail end of 2008, beginning of 2009.
perfect
TFSAs
timing.
just rolled out. Yeah, I thought I was a genius. I was like everything I invested in, my personal TFSA did like 40% that year. Not because I was good, it was just timing, and I
Yeah,
didn't know any better. I was brand new.
yeah.
Uh, I've been humbled a little bit since then.
Yeah, my last, I know that you asked about passive indices, and there's certain areas within the equity markets from a passive perspective, like US equities, it's proven. The fact is, it's very hard for the average investment management firm to outperform the S&P 500 over long periods of time. So if you just want US equity exposure, there's nothing wrong with going with a passive strategy. Recognizing if you're just buying the S&P 500 today, how top heavy it is in just 7 securities.
Right. Very true. Very true. Um, Maybe if we could rewind the conversation just a little bit. You started to talk about AI companies and the AI space. There's some talk about now that there's more and more companies popping up and market shares starting to be kind of established and what's going on. What are your thoughts on maybe this year and the next couple coming years? Are we going to see more AI players? Are we going to see a roll up or mergers of companies in order to like survive? What are kind of like the talks that are happening behind the scenes with you about the space and what's potentially going to happen?
Yeah, I think there's going to be several winners, and I think I'm not going to speculate which ones are the winners, but I think we've all heard, Anthropic, OpenAI, Grok, there might be Gemini. I'm not really familiar with some of the others. That's not to say there's not some emerging technologies that are going to be even better. I think the what I'm hearing is the revenue being generated by these firms is just compounding poorly. So this is not the tech bubble where there was businesses that had a great business plan and didn't actually. I'm not sure if you may not remember the term we used back in 1999 called vaporware. It was software. It was an idea of software. Nothing really built, and these companies were trading at ridiculous valuations. So this is different.
Okay.
These are companies that are actually generating significant revenue. So there's going to be some big winners. I'm not familiar with the losers, but I think you have to take definitely a diversified approach. We, as a firm, we've got a bit of exposure to the three I just mentioned. OpenAI. We're actually going to be looking to allocate, I believe, to Anthropic. Let me put it this way: we've got an opportunity to invest in its pre-IPO round. We haven't made any
Yep.
decision if we're going to do that, and we've got a bit of exposure to XAI, which is the Elon Musk business. So, yeah, I think there's more money to be made. Probably, well, there's going to be a lot of money to be made there, but I think there's a lot of money to be made through the data centers, right? Data centers, which is really driving uh, the demand for, or AI is driving the demand for data, and it's compounding. It's doubling about every 3 months. And so you have to know who you're partnering with on the data centers. And the reason I'm bringing this up is because we just had, as I mentioned earlier, I had breakfast uh, with Digital Bridge, and we're in a fund of theirs that they took for the data centers they're developing and put them into one package. And the growth, the contracts these businesses are getting is just ridiculous. And those are businesses like Advantage or a couple of these others that already have pre-existing relationships with firms like Meta, like Google, like Amazon Web Services. And when you've got those relationships established, they're just printing money. I'm not talking
Yeah,
about 50% a year, but I'm talking about very consistent growth. And then, but you just can't set up a data center anywhere, right?
right.
The thing that you need is energy. And so that's driving another kind of opportunity set. And it's typically what I did read recently is something like 90% of energy being used by data centers that have been set up over the past couple of years is through renewable energy. So that again is creating another opportunity for investors on the infrastructure side, digital renewable energy, which we have a pretty healthy exposure to in our real asset pool.
Nice.
So it's driving a lot of opportunities. It's just not these large language models like, OpenAI. It's all of these ancillary effects that investors are able to tap into if you're willing to go into the private side of the markets.
Yeah, very true. Very true. I think as a consumer is we get sucked into the thing that we know, the thing that we use, which is we like ChatGPT or an OpenAI platform, a Gemini platform. And from a consumer point of view, we're using it essentially for search and ask questions and stuff. Whereas from an industry point of view, we're talking about like full self-driving, and we're talking about robotics, we're talking about
Mhm.
medicine. Like it's looking
Yeah,
into so many
yeah.
different areas that it's not at the consumer level yet, so we don't think about that.
Yeah, no, that's a good point. I think everyone, when we think about AI, we think about ChatGPT without realizing that so many industries outside the technology sector is employing some form of artificial intelligence in their businesses.
Yep,
Yeah.
yeah, very true. Um, with the changing dynamics in interest rates and the Fed announcing end of QT, which I didn't even realize they were still doing that. There's been a lot of talk about 2026 and going forward is going to be like the year or the phase of IPOs because IPOs kind of like stopped for a little while.
Mhm.
What are you hearing on your end about exciting things that companies that are going to launch, they're going to go public, or they're going to be the opportunities there for people who are trading in that space, or for people who are already holding the companies in a private format? What are
Yeah,
some of the maybe like headlines or exciting pieces that are coming?
well, I'm not sure if this is what I'm going to tell you is exciting, but just a bit of feedback on that is the IPO market basically froze. Or even mergers and acquisitions, which is not every private company IPOs. A big chunk of private equity companies are bought by another firm through M&A. Um, a lot of private equity and infrastructure and real estate is financed by debt. When the cost of capital is 2%, you know, things are great. When the cost of capital is 8 or 9%, that's a lot different. And so
Yep.
businesses or firms who are looking to the M&A to make some mergers, acquisitions, whatever it is, the cost of capital was just too expensive for them to make these acquisitions. Now there's more stability. There's more uh, firms looking to acquire other firms. For private equity firms looking to acquire a firm have much more confidence in the level of interest rates. So they're able to make decisions uh, going, I don't know where interest rates are going to be in 3 years, right? So now, because of that stability and a more a level of rates that they're comfortable with, I think you're going to see a lot more activity this coming year. Um, I'm hoping, and IPOs. I think I spoke with someone today or yesterday, and they're starting to see, of course, it's the old comment people use in the industry. We're starting to see green shoots. So I like seeing green shoots. It means that things are starting to thaw a bit. And in fact, we have a lot of investments, especially in our strategic income pool. Our biggest holding hadn't done very well for probably 2 years. It wasn't negative, but it didn't, not because there was anything wrong with it, but a big part of its return profile is due to selling mortgages and into the marketplace, but there hadn't been a demand for those, so things were staying on their balance sheet. But the securitization market has kind of thawed, and there's starting to be a bit more activity, and that should flow through to better returns for that particular strategy. So because the cost of capital has kind of moderated, I think we're going to see more activity. Now, the caveat is, Greenland's not taken over. We don't, my biggest concern is geopolitical risk, right?
Okay.
And so things like that, think about last spring with tariffs that added a level of volatility to the markets. That the markets don't like volatility. They don't like uncertainty. They don't like geopolitical risk. So I'm hoping going forward that, yeah, the caveat is we don't see any of that this year, that things should be pretty smooth. I'm hoping. I'm hoping. Yeah.
Yep. Okay. That sounds good. I mean, that's what I'm hearing too, and I'm also hoping. I think
Yeah.
I'd like to see that.
I think you and I were chatting offline. I should give an example of one of our funds and this can give your, investors an idea of when I say I think there's a lot of value. I'm just going to talk about private equity right now. I think there could be a lot of value locked up in funds that is waiting to be recognized at exit. And so one of our funds sold their first position. They're holding 12 companies. They sold their first company. This is a 2019 vintage. Usually vintages start, if you launch a fund in 2000, let's say 20, you're starting to dispose of things by 2024, 25. This is a 2019 vintage. This was their first exit. They
Wow.
sold it. They sold it at 105% premium to its last valuation. Okay. So when I say I believe that a lot of these managers are holding assets that I, top tier managers tend to be very conservative when they're pricing their assets. They don't want to have to tell their LPs like us, by the way, we had it valued at here, we sold it at this. So they
Right.
tend to be quite conservative. Historically, there was a good report that Dawson Partners put together a couple of years ago showing they tracked something like 1,000 different um, uh, exits or private equity funds that had sold businesses over I think it was a 15-year period, and the average exit premium versus its prior valuation was at about a 28% premium. So if you
Okay.
believe the history will hold up, there, I'm a believer that there's a lot of value that's not recognized yet.
Awesome. Um, Maybe switching tracks a little bit, talking about predictions and what's going on in the future. We've had the rise of something in based out of the States that seems to bleed into every area. Sports gambling, who's going to say what. And, of course, I'm talking about poly market and prediction markets.
Mhm.
Like from a fund manager's point of view, what do you say to some of the goofy stuff that comes up and the people who are utilizing this or looking at this?
You know what? I don't even look at it.
Okay.
But it's such a massive industry.
Yeah.
It's sports betting and just betting on anything is
Yes.
massive. But I don't think we can really, from a investment perspective, I wouldn't be looking at anything like that. So I really don't have an awful lot of comments on that. Something just came. I'm going to completely jump outside of this question, and we can come back to it. One of the things that I should point out, and I think this will have a much larger effect longer term because we haven't had a lot of our capital called, but it's a very interesting investment strategy, and it's called legal opportunities.
Yep.
It's where the fund we deal with, they help firms uh, finance the legal costs of, say, fighting patent litigation or antitrust. And so we had a big settlement, and I knew it happened back in last June. Not sure if I can mention. Anyway, we were involved. Our fund was involved with financing a case where the state of Texas was suing a very large technology company for antitrust. 40 other states had gone and had sued Google for, see, I just mentioned Google, for antitrust, and they were awarded something like 400. I mean, it's public knowledge. They were awarded 450 billion, $1 million, and Texas said, no, we're going to go on our own, and they were awarded for damages $1.2 billion in damages, and the
Wow.
fund we're in were involved in some of that financing. So I think it turned out to be something like a 3.6 multiple on invested capital. So for every dollar that they committed to this, they got about close to $4 back. It's a
Wow.
very interesting strategy. Why I think it's interesting is because it has absolutely zero correlation with anything else that you can think of. Doesn't matter what the economy does not matter what the equity markets do, or fixed income, or rates, or monetary policy. It is completely independent of that. And if you can have exposure to something that literally has got zero correlation, you want some of that in your portfolio. So that was a pretty interesting one. And I think again, you don't get the returns tomorrow. Typically takes about
Yes.
18 months by the time they finance something to it settles. And I think over the next couple of years, we'll start seeing more of that value being extracted out of this fund. Yeah, that's one I'm really, really excited about longer term.
Yeah. I think that's a really cool strategy that where else would you get access to that? Like how would a normal everyday person get access to that other than through a fund or through a fund manager? I
You
mean,
can't. And one of the
yeah.
things now, what they've actually done, which was not in their plans when they first launched it, they're now buying intellectual property portfolios of intellectual property. So not only are they're going to be the litigant, but they're also the owner. So you don't have to share any of the profits because typically so for example, Pretium, if they help finance a patent litigation, and they win, they'll take maybe 48% of the proceeds, right? So in this case, you're taking 100% of the proceeds. So yeah, and I know they've been buying portfolios of IP. So I'm really pumped about that strategy.
That is really nice, right?
Yeah.
And so like in a if we look at the pie of like what a regular investor has, what slice of the basket would something like that be? I mean, it can't be a huge exposure, but
No, it's
it's
not going to
nice to have
be,
some.
yeah, it's in our strategic growth pool, which is when we first committed and we committed 20 million US dollars, it wasn't 500 million. Um, we haven't had an awful lot called on this portfolio or on this pool yet. I think it's maybe, 1.75% of the pool. But,
Okay.
I listen, we've got a number of investments. All we're looking for, if I mentioned this one that was sold at 105% premium, right? We haven't got our statements yet for that. It was the third biggest holding or second biggest holding of a fund that's 8% of our pool. If that adds 50 basis points to performance, if that other one IPOs and adds 30 basis points, and this one adds 75 basis points, that's what we're looking for. We're not looking for all the returns coming from just one. How'd the S&P 500 do, right? We're not
Right.
dependent on the returns of just US equities or equities in general. Our
Right.
portfolios are there's so many different return drivers that will drive returns in our pools over the long term. And that's what we're trying to achieve.
Gotcha. Um, I guess my last question, or my last area of questions is we were talking a little bit offline just about private credit and what that looks like. It's become like a huge industry. I know mutual fund wrappers are trying to get into that space. It's hard to get that approved from a compliance
Mhm.
department, but um but in the private credit space, we've had a couple of like Canadian companies catch headlines and maybe have some allocations that didn't work. One was fraud and other stuff.
Mm,
Um,
mm.
so like what are you looking for from like an underwriting kind of back end process of choosing really good curated private credit partners and like what is it adding to the portfolio?
Yeah, I'm a big fan of private credit, but private credit comes in so many different flavors. There's direct lending, there's asset-backed financing. I mean, the category of private credit is like this, but I think when most investors think of private credit, they think of direct lending, right? And most of our 5 years ago, 3 years ago, if you wanted private credit in Canada, there was almost no availability in Canada for what I would call an institutional manager, like a Morgan Stanley, like a Blue Owl, like a Oak Tree, or a number of other ones. They've all come to Canada now over the past 3 years. So access to institutional quality managers, you've got your choice of managers on the direct lending side. Some of these other different strategies tend to be in closed-end structures, which we have a number of exposures to. Now, I think the difficulty for Canadian managers, and this is not a criticism of what they do, because I think there's a lot of really good ones. You need a niche strategy that differentiates from what the big guys in the US have, who manage. Ares manages $540 billion in private credit. They're one of the biggest in the world. Blackstone manages a ton of private credit, right? So they've got years and years of experience there. I think the difficulty for a lot of Canadian ones is that they're now competing with the big guys out of the US. And as an advisor, you're going, is there any headline risk if I invest in an Oak Tree or a Morgan Stanley direct lending fund versus is there any headline risk if I invest in this smaller Canadian one? And I think that's what investors, advisors are looking at today.
Yep.
It's trying to, I don't want headline risk. There's been a lot of headline risk with bridging capital and some of these others over the past couple of years. I don't think you're going to get, in trouble from a fraud perspective if you've got Blackstone. So again, no reflection on the quality of the work that these Canadian managers do. I just think that they now have to compete with the big guys out of the US, which is going to be difficult. So I would say the vast majority, except for one high quality Canadian private credit manager that we have, which we're very, very happy with. Almost every other private credit on the kind of semi-liquid is US based. And then we've got
Okay.
a number of strategies that we've committed to out of Europe. So we're now broadening our private credit. And again, private credit is this wide. We've just committed our most recent commitments are more to European private credit, which is where a lot of the industry is starting to look at for opportunities.
And with that, Brent Smith has had to jump off. Thank you, everybody, for joining this episode. If you're looking for more information on Kinsted Wealth, you can visit their website, kinstedwealth.com. If you're looking for more insights, financial planning tips, or guidance, you can reach out to us at portfolioplanning.ca. We'd be more than happy to book an appointment with you and have a chat. Thank you very much. I'm Tyson Agasaka, and this is Portfolio Talks.